You are competing against an expert on Wall Street making $1 million a year to devote themselves to the stock market and know everything about the stock market. So how in the world are you supposed to be able to compete with them? Well, it's actually easier than you might think. What's up, everybody? I am Jaspreet Singh, and what I want to do today is go over the best ways to invest your money. There's a lot of talk out there about investing your money into pictures of apes, investing your money into cryptocurrency, investing your money into real estate, investing your money into the stock market. But today, I want to break it all down and go over the best ways to invest your money. So let's jump right into it. Ray Dalio is one of the most well-known hedge fund managers because his hedge fund Bridgewater was one of the most successful hedge funds because his company focuses on studying the data. They study historical data and they make their investment decisions based off of trends that they've seen happen in the past. Throughout the year 2021, Ray Dalio said again and again and again that cash is trash and you need to do something with your cash. That way you can get a better return with your cash instead of just keeping your cash in the bank and watching it get eaten away by inflation. Because when you are in a low interest rate environment, low interest rates mean you're going to see more people go out and borrow money. You're going to see more businesses go out and borrow money, which creates more inflation because more dollars are entering our economic circulation. And when you have more inflation, well, the value of each individual dollar goes down. So low interest rates, high inflation, which makes cash trash. When you're in a high inflationary environment, what you want to do is you want to be converting your cash into an asset that is getting benefited through inflation because now you own something that's going up in value instead of owning something that is losing its buying power every single day. Like through the year 2021 and through most of 2020, we saw the value and buying power of dollars go down while the price of stocks went up. We saw the price of real estate go up. We saw the price of cryptocurrency go up. So if you were one of the asset owners, you benefited because you got richer. You took your cash, you converted to one of these assets, stocks, real estate, crypto, and you became wealthier by doing nothing except owning the asset. But if you had that cash sitting in your bank account, you effectively became poorer because now it is more expensive for you to go out and buy stocks, and it became more expensive for you to go out and buy real estate, and it became more expensive for you to go out and invest your money into these type of assets, not to mention the fact that the buying power of your dollar went down. So not only is it more expensive for you to go out and invest your money, but it also became more expensive for you to go out and just live your life because your rent became more expensive, your groceries became more expensive, your vacations became more expensive, so the cost of living went up and the cost to invest went up while the people who invested their money saw the benefit. I love studying other successful investors. I really like studying Ray Dalio. I've read his books, I've read his papers, I've read the things that he does. And so what I want to do in this video is go more in depth into Ray Dalio's thought process and what he says that you can do with your cash because as he says, cash is trash. That way you can benefit from the inflation that we have going on because Ray Dalio says that there are 3 things that you should be doing with your money, 3 ways that you can get your money out of cash that way you can benefit from this inflation. In an interview, Ray Dalio talked about the 3 places where he says you should diversify your cash. What he says is rising inflation and low interest rates are creating risks for our investors, but cash is not the answer because what he says is, quote, "Know that cash is trash. Don't keep it in cash. The most important thing that an individual investor can do is know how to diversify well." Ray Dalio goes on to say that you should be diversifying your money across 3 different areas. First is in different countries, second is in different currencies, and third is across different asset classes. He says that if you diversify your money this way, it will outperform cash. Let me start by talking about diversifying across different countries because this is something that just recently I started to talk a little bit more about it. So the United States is the largest empire, the largest economy, the largest military presence, the largest country, the most powerful country in the world, which is great. But one of the downfalls with being so big is when you're so large, it's harder for you to grow very quickly. You could think of it like comparing a small growth startup company with a blue chip massive established company. When you're a small startup, you can be more nimble and you can work to grow faster and you can innovate and you can acquire more market share. So you have a lot more upside when you're small. Obviously you have more risk, but when you're large, all you're really trying to do when you're a big massive company is just grow steadily, continue to make sure you're getting your sales, continue to slowly drive revenue. I mean, you're just so big. You're a massive machine where you can't move as fast as you could when you're small and nimble. And so that's the issue with the United States. The United States economy is massive. We are the largest economy, the most powerful economy in the world, and so we just don't have the ability to grow as fast as we used to when we were a lot smaller. Back in our parents' and grandparents' time, it wasn't uncommon to see the United States economy grow by 5, 6, 7, 8, 9% a year. And so if you were investing your money into the United States economy, you were seeing a lot of growth because the economy was naturally growing as well. So you could see a lot of upside just because the economy had so much room to grow. Now, obviously our economy is still growing, it's still very powerful, but it just doesn't have the ability to grow as fast. And so if you were trying to see upside, well then you might want to consider investing your money into something a little bit smaller, like an emerging market, a smaller country where the economy is growing, because these countries are trying to grow a lot quicker, they can be more nimble, they can acquire more market share, versus the United States economy is more kind of like your blue chip. It's just lower, steadier growth, but if you want to see more potential upside, then you might have to consider moving some of your cash into some of these companies overseas or in these emerging markets. That way you can see more of the potential upside, especially now if you're trying to see higher growth. Because if we just think about inflation, if your goal now is to beat inflation and you want to outperform inflation and get a good return, well, that doesn't mean that you can just get a 1% or 2% return on your money. You're going to need a more significant return on your money. And one of the ways that you can do that to kind of counteract this inflation is by investing your money in some emerging markets. Now, there's a few different ways that you can invest your money in different countries. One is you actually go to the other country and you find investments there. The second is you try to invest your money into their stock exchanges. And third, which is the most accessible, is you invest your money into an ETF here in the United States. And this ETF can then give you exposure to these emerging markets. An ETF is an exchange traded fund. They trade just like stocks on the stock market. They have a ticker symbol. Here's a few examples I'll go over in just a second. They trade just like stocks. You can buy and sell them like stocks, but the difference between an ETF and a stock is when you invest in an individual stock, you're getting exposure to one company. If you go out and you buy one share of the Amazon stock, you only have exposure to Amazon. Versus when you invest in an ETF, you're getting exposure to an entire fund, which could be hundreds, if not thousands of companies. So 3 different ETF examples of emerging market ETFs are SCHE, which is the Charles Schwab ETF for emerging markets, VWO, which is the Vanguard ETF for emerging markets, and IEMG, which is the iShares ETF for emerging markets. Now, a little disclaimer, I do own VWO and SCHE. Now, in terms of the size of these ETFs, this one is the largest, this one is the second largest, and then the Schwab one is the third largest. And each one of these 3 ETFs go out and they invest in companies in emerging markets, countries like China, India, Taiwan, Brazil. So just depending on what the ETF is, different ETFs invest in different countries. They have different exposure to different countries. Like VWO has quite a bit of exposure to China. Other ETFs have a little bit more exposure to Korea or other emerging markets. So you got to see which countries you want to invest in. And then based off of that, you can also see how big of companies you want your ETF to be invested in. So for example, SCHE, the Schwab ETF, invests mainly in the larger companies in these emerging markets. So this has the smallest amount of actual companies in the ETF, and the reason being is they want to invest in your larger cap, bigger companies in emerging markets. VWO and IEMG also invest in bigger companies. They invest in like the mid cap to the large cap. But overall, if you look at the average size company in these 2 ETFs, they're not as big as the companies here. So you got to get an idea of, okay, which countries do I invest in? And what size of companies do I want to invest in? Then you can make the investment decision to see if this is a good investment option for you. Remember, you should always do your own due diligence and never blindly listen to a random guy on YouTube, because investing has risks and you're never guaranteed to make money when you invest. Now, inherently, when you invest your money into an emerging market, that is riskier than investing your money into the United States because, like I said before, the United States has a very strong, very established economy, along with military presence, along with government. So when you're investing into these emerging markets, not only do you have the risk of these countries being smaller, they don't always have as strong of a military presence, they don't always have as stable of a government, but now the companies there will also be facing the uphill battle because now they're trying to grow in a smaller country. So you have to understand that there's inherently more risks when you invest your money into an emerging market, but it's one way for you to diversify your cash now outside of the United States, outside of this country. That way now you can get exposure into some companies and countries that are trying to grow bigger, faster. When you're investing in ETFs, whether you're investing in emerging market ETFs or any other kind of ETF, the way you win is not by trading ETFs, buying in the morning or selling in the evening, or buying one day and selling next week, or buying one day and selling next month. The way you win by investing your money in ETFs particularly is by investing your money for the long term. So the way you win by investing in ETFs is by investing your money consistently, passively, and then letting your money grow and compound over time. That's how you win with ETFs, because when you invest your money in ETFs, your goal is to invest your money for the long term. It is a long-term investment strategy. It is not a trading strategy. So you have to understand that there might be times where you see your ETF go down. And if you believe in your ETF, well, that is the time for you to come in and buy up more shares at a discounted price. That way you can invest for the long term. But the key to win is to invest for the long term if you believe in this idea of investing your money in outside countries. The second way that Ray Dalio talks about investing your money is by investing your money across different currencies. So the United States dollar is one currency, and then you have the Japanese yen, then you have the rupee. There's a bunch of different currencies. Many different countries have their own currencies, and the whole idea behind this is if you are worried about inflation, which is what we've been seeing happen for a long time now, and inflation continues to get worse, well, then that means that the value of the dollar will go down. So if you own some different currencies, you convert your dollars into different currencies, well, then that could be a protection against your dollar, because if the dollar starts to go down, then the value relative to these other currencies would go up. Now, I'm going to be honest. I am nowhere near an expert in currency trading or currency investing, but the thing that I want to talk about is he also mentioned cryptocurrencies. Going back to the article on the street, Ray Dalio says that if Bitcoin achieves widespread acceptance, then regulators will come in to control it. And he said, quote, "At the end of the day, if it's really successful, they will kill it because they have ways of killing it." Then he goes on to say that given Bitcoin's lack of intrinsic worth, it's hard to know what the cryptocurrency's ultimate fate will be, because there are so many things in a historical perspective that didn't have intrinsic value and had perceived value. They went hot and then became cold. Bitcoin could be one of them. So what he's saying is that the ultimate fate of Bitcoin is yet to be determined. Ray Dalio does own Bitcoin. He's talked about this in other interviews. He says that he does own Bitcoin. It's not a huge piece of his portfolio. It's a very small piece of his portfolio, but that is kind of like a protectionary hedge, kind of like gold. And to him, it's also a way to protect against inflation. But what he's saying is that we still don't know what's going to happen with cryptocurrency like Bitcoin. And there's a chance, according to him, that it could flop. And then the third way that Ray Dalio says that you should be investing your money is within the United States itself, is across different asset classes. So this would be things like stocks and real estate and businesses. So asset classes, businesses meaning not publicly traded companies. So what he's saying is not only diversify across companies in different countries, diversify across currencies, but then diversify within the United States with different asset classes. This does not mean that within your stock portfolio you have a blue chip fund and then a startup fund and then a healthcare fund. That is not diversification across different asset classes, because it's all within paper assets, stocks. So what he's saying is different asset classes, meaning things like stocks and real estate. Going to the CNBC article I mentioned in the beginning, Ray Dalio says, quote, "Cash is not a safe investment. It's not a safe place because it will be taxed by inflation." It's an interesting way to word it, that you're taxed by inflation, but it's not wrong, because when the United States government wants to spend money on their operations, they can raise their money by taxing people, so they raise their taxes, but they're never able to tax people enough, even if they raise taxes on the rich, to cover all of their spending. So what do? Well, then they print the rest of their money. So if they can't raise it by taxing, then they print it. When they print the money, this causes more inflation, and more inflation hurts the average person, the person who's not financially educated, the person who doesn't understand what's going on, because now your rent is more expensive, your groceries are more expensive, your life is more expensive. So you're taxed through inflation, because now if you just save all of your cash, this money spending causes more inflation, which hurts the average person. The concern a lot of people have is, why should I put my money in the market right now when we're close to market highs? We are at such high points in the market. Why should I put my money in and then risk a potential market crash coming in, and then I could lose a big chunk of my portfolio? And Ray Dalio addressed that. In that same article, he went on to say that you can reduce your risk without reducing your returns. He says you will not market time this. even if you were a great market timer, the things that are happening can change the world, so it changes what could be priced into the markets. So what he's saying is you cannot perfectly time the market. Nobody knows when a market crash is going to happen. No one knows if it's going to happen tomorrow, next year, or in 5 years or 10 years. There's no way to time that. But what he's saying is we have a lot of other things happening in the world, like inflation, which is a big concern. And if you don't do something with your money, well, then this inflation can eat away at your money, and it could affect the markets, because what that means is if inflation started to get really bad, the value of the dollar goes down, and you start to see, even if it's a minor dollar crisis, well, in turn, that makes the price of assets like stocks and real estate go up, which means that now it's more expensive for you to go out and use your dollars to buy stocks and real estate because of all this inflation. So it's kind of like a reverse crash where the value of your dollar crashed, which in turn makes it more expensive for you to go out and buy stocks and real estate. So even if your stocks and real estate aren't more valuable because, it's just that the value of the dollar went down, it'll be much harder for you to go out and buy stocks and real estate with your dollars just because the value of your dollar dropped. Ray Dalio says that the excess money supply in the system could create certain economic and political problems. He went on to say, quote, "You cannot raise living standards by raising the amount of money and credit in the system, because that's just more money chasing the same amount of goods, and it will affect financial markets the same way we've seen, and it will affect the inflation rate. It won't raise living standards in an important way. As inflation then begins to bite, it has political consequences." The easiest way for me to explain that would probably just be by diagramming it out. So let's assume that you have 5 people in this world. 1, 2, 3, 4, 5. And in this world with only 5 people, each of these 5 people only have $100 because that's just the way the world works. And in this world, they all want to be able to purchase this car. You only have one type of car in this world, and this car costs $50. Well, let's assume that suddenly each person in this world went from having $100 to $1,000. Now, all of a sudden, each one of these people are going to feel richer. And let's also assume that the way that they grew this number of dollars that they had, I can't say wealth because you'll see why in just a second, is the government here said, you know what? We are going to print this money out of thin air, and we're just going to make you all richer. So the government gives each person $900. So the government gives each person $900, each go from having $100 to $1,000, and everyone says, holy cow, I am rich. I just 10x'd how much money and wealth I have. Well, what's going to happen? Do you think this car is still going to be on sale for just $50? No, because there's so many more dollars in circulation. The value of each individual dollar went down. Nothing was produced to actually create more wealth. The only thing that was created was more money out of thin air, more dollars. And so what happens is each individual dollar goes down in value, which would cause, in turn, the price of this car to probably go up to $500. So you felt rich for a minute because now you were like, hey, I got some more money out of thin air. But then over time, you're going to realize that you're no more wealthy than you were before. I mean, if immediately you got this new money and it hadn't gone into the economic system yet, you could have gone out and bought 10 cars or 20 cars. You might have felt richer. But eventually this car owner is going to say, wait, these dollars that I'm getting aren't worth as much. And so then the car owner is going to say, I can't keep selling cars for $50 because it's costing me more than $50 now to produce this car because the value of the dollar keeps going down. I keep getting these dollars from these people, but the dollars aren't worth as much. So that's why this car owner will then be forced to raise the price of the car to $500 to meet the market, which means that now you have more dollars, but you're no more wealthier than you were before. That's what he's saying. You cannot raise the living standards of people by just creating money. You create money, you send it to people, you give it to people, you have it inject into our economic system. Then people take these dollars and they go out and they spend it. They go out and buy things. These things are made overseas in China and India. And then these countries and companies say, okay, we'll accept your dollars for now. They produce products, real things, real goods. They ship it out to the United States, created a supply chain mess because we created demand out of thin air. People suddenly started living a whole lot bigger. They started living a whole lot nicer without actually producing anything because the government was producing money out of thin air. And then now you have all these orders coming in. You have the backlogs of people, and it came from what? There was no actual production of value in the United States. The only thing that we produced was dollars. So we produced dollars, enter it into our economic system. People that have more dollars, they go out and spend it, and then that causes the price of things to go up, because then the producers say, yeah, we're selling stuff and we're getting these dollars, but these dollars aren't enough anymore to cover the cost of our goods, which then cause the price of things to go up. And then people suddenly say, oh, I thought I was wealthier. I was spending so much money, but I'm no more wealthier now than I was before. This is the concern with inflation that Ray Dalio is talking about. And the reason why he's saying it's going to cause economic and political issues is because, well, we've already seen a lot of social, political issues over the last decade. And now as people don't feel included in the system, anytime you see a bigger divide between the rich and the poor, well, that creates more unrest. Well, who do you think inflation benefits when inflation happens? Because when people get this free money, when they feel like they're wealthier, what do they do with it? It's not that they take this money and they go and invest it in themselves, they pay off their debt. I mean, sure, you have some people that do that, but the average person takes this money and they go out to Kroger, they go to Amazon, they go to Lululemon, they go to Apple, and they go and spend this money. So the money flows right up to the top. The money flows to the rich and wealthy. And so this money gets printed, it gets created, enters the economic system, the people get it, people spend it, it flows to the rich and wealthy, and now you have a bigger concentration of wealth, a larger number of dollars controlled by the rich and the wealthy, and now the poor have a smaller concentration of dollars, and each individual dollar isn't going to stretch as far. Each individual dollar doesn't have the same buying power as before, and this now creates a bigger divide between the rich and the poor. Like I said before, anytime you see a bigger divide between the rich and the poor, it creates more social unrest. So this is what he's talking about. That is the concern. Because now when you create more inflation, it benefits the wealthy, it benefits the financially educated, and it hurts the average person. The average person pays the price for inflation, which is why it's called a hidden tax, because it is a way for the government to raise taxes without actually legislating anything. Because if the government wants to raise taxes on people, they have to get it approved. But if they just print the money, well, then it's not as hard, and people say, oh yeah, great, we're spending more money. But who pays the price for this money spending? The average person. Because now your groceries and your cars and your vacations and your rent become more expensive because the dollars that you use to go and buy these things no longer stretch as far. The last thing that Ray Dalio said is, quote, what we're seeing happen has played out many times in history. It's like watching the movie over again. So when it comes to investing your money in different asset classes, what Ray Dalio is saying is, yes, we could potentially see a crash, but he says the bigger risk is what could happen with inflation, which is why you don't want to try to time the market, and you want to continue to invest your money smartly across different asset classes. That way you can put your cash to work, because your cash in this environment is a liability, or as he says, cash is trash. The stock market is one of the most accessible wealth building tools that you can access. But lots of people never actually end up making money or building wealth in the stock market. There are essentially two ways that you can invest in the stock market. You have the cool way, oh yeah, and then you have the boring but profitable way, oh yeah. When most people invest in the stock market, they're trying to find the next Amazon or Tesla. They're trying to be cool. It's the cool way to invest because you want to find the next hot stock and buy it before it gets big. You can make a lot of money doing that, but it takes a lot of time and it takes a lot of research, and most people don't actually put in the work to do it. They're just gambling. And there's a lot of people, especially when you first enter the stock market, that get really allured by this idea of being able to flip a stock very quickly for a huge profit. Like you see this penny stock trading at 4 cents a share and you think, whoa, what if I buy $1,000 worth of this stock and it goes up to 8 cents a share? That's not that big of a jump. If that happens, I'm gonna make $1,000. And if the stock goes up to $1, I'm gonna have $25,000 doing nothing. And the next thing you know, your money's gone because that stock went out of business. Trust me, I know, I've been there. Even if you're too smart for penny stocks and you're investing in well-established companies, chances are you felt the pain of investing in a company and then you see your stock go down. I mean, that's why so many people are searching, why do stocks go down when I buy them on Google? So now you have a lot of people that are investing in companies and losing money, and then you also have this big group of people that are scared to invest invest in stocks because they see all these people lose their money. But there is another way that you can invest in stocks that doesn't have as much risk, where you don't have to try to find the perfect company, where you can build sustainable wealth. The downfall with this is kind of boring. It's not as cool as trying to find the next Amazon. So what is this secret system? Index funds. Index funds, not to be confused with index fingers or index cards, are a simpler but boring way for you to invest in stocks and build profit over the long term while compounding your wealth. An index is a group of stocks, is a segment, and a fund is something that you can invest in. So as a simple example, let's say you really like tech companies, but you don't know how to find the best tech stock. So let's create a tech index fund. So remember, an index is a group of stocks, and in this, we're gonna create one right now. Let's put in Amazon, AMZN, these are the ticker symbols, Facebook, Google, what's another tech stock? Apple, AAPL. So now we have just created an index, which is a group of stocks. Now, if you want to invest in this group of stocks and you don't want to individually invest in all these companies, you can invest into this fund. So now this has just become a fund. This fund invests in these individual stocks and you can buy shares of this fund. Now, you're not going to be the person that's actually creating the fund because there's a lot of complexities into that and they get a lot bigger than this. I'm just showing you kind of as an example of what an index is, but you as an investor can invest into a fund which invests in a bunch of stocks. That way you don't have to try to find the best company to invest in. The reason passively managed index funds have become so popular is because back in the day, the only way that you could invest in funds was by investing in what's called actively managed funds. Here's the thing, someone or something has to manage this index of stocks, because if Facebook goes out of business because people don't want Facebook anymore and people stop buying Apple iPhones, then what's going to happen to this fund? You're going to have only some stocks that are doing well and all these stocks that are going bankrupt. And if that's the case, your investment is going to tank. So someone or something is going to have to actually manage this fund to make sure that the stocks in here are doing well. And you're not going to be the one doing that, because the whole point of investing in this fund is so that you don't have to do all the work. In actively managed funds, what would happen is you would have this person right here manage this index. So let's draw a nice mustache on this person. And this person probably went to Yale for undergrad, and they went to Wharton for business school for their MBA. And to most people, that means they're probably very smart. Now, to me, I'm sure they're very smart, but what that means to me is they're probably going to charge you a whole lot of money. And that's exactly what these money managers did. So they would create this fund and then they would charge you a whole lot of money. So this is you, the investor, and a lot of your money would go right into this person with a mustache's pocket. So if you wanted to invest in stocks, but you didn't want to put in the time and effort to research companies and to manage your stocks, then what you would do is you would hand over your money to this money manager with a mustache who went to Yale, who went to Wharton, who is now going to charge you a whole lot of money to take your money and put it into this index or fund that they are managing. And if your index, your investment goes down, they're still going to charge you a lot of money. This model is why index funds, as we know them today, were created. Now, I have nothing against mustaches, but I really like the idea of people being able to invest their money without paying all their money in fees. The way it worked is, instead of having this guy with a mustache manage your money, how about, and let me erase the mustache and the person, how about we just have a computer manage your investments, because computers are a whole lot cheaper to manage, and we can just tell the computer, hey, why don't we just create this investment where this fund invests in the top 10 tech companies. And now if Facebook goes bankrupt, this computer can automatically kick Facebook out and put in a new company. So this was automation coming into the money management and investment game, because now instead of paying an expensive money manager, people can create an algorithm of what type of companies they want to invest in. And so if you want to invest in the top 10 tech companies and one company goes below that threshold, this computer will automatically kick this company out of the fund and bring in a new company. Like if Facebook goes out, maybe Snapchat will come in. This computer will automatically calculate that and make these transactions. That way your fund has the stocks that you have in the algorithm. Two things happen when you do this. First, you as the investor, you get to save a whole lot of money, because managing a computer is a whole lot cheaper than paying a money manager who went to Yale and who went to Wharton to manage your money. And second, you get to take the emotion out of investing. The reason so many people, including high-paid money managers, lose money in the market is because people are emotional beings. When the 2020 pandemic hit and the stock market crashed, do you want to know what a lot of expensive money managers did? They sold. They were selling stocks out of their fund out of fear. If your fund manager makes bad trades and you lose money in your investment, but you also have to keep paying your money manager. Look, there's a time and a place for actively managed funds, but if you really want to get the good money managers, you need a lot of money to invest with them. So now we're talking millions of dollars. If you don't have millions of dollars to invest, chances are you're not going to get access to the greatest money managers. Passively managed funds let you invest your money into stocks while paying low fees, and a lot of times these passively managed funds will get you better returns than actively managed funds, and you get to pay way less in fees. But in order for index funds to build you wealth and really make you money, you have to invest in them the right way, because this isn't one of those things where you can just invest in an index fund on Monday and expect to be rich by Wednesday. Index fund investing is a long-term wealth building tool, and the way you make the most money and build the most wealth by investing in index funds is by investing money consistently into the index funds and investments that you have. So this is investing money every week or every month into your funds. Now, investing has risks, okay? You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. But let's take a look at this. So VOO is an index fund created by Vanguard, and VOO invests in the top 500 companies in the stock market. Okay, so VOO is that index fund and invests in these top 500 companies. So now what you can do is you can invest into this fund. Again, I'm not telling you what to buy, just an example. And this fund gives you exposure to the top 500 companies. Between November of 2010 and November of 2020, VOO, this index fund, returned an average of 13% a year over the last 10 years. This doesn't mean that the fund went up by 13% every single year consistently. It means some years it went up more than 13%, some years it went down by 13%, but on average over those 10 years, this fund went up by 13% a year. Let's put this in perspective. Let's say you had $10,000 and you put this money into the bank. And I'm going to be very generous, and I'm going to say that your bank paid you a half of 1% a year in interest. If you did that over 10 years, your $10,000 would grow, and it would grow to a whopping $10,500 after 1 decade. If you put your $10,000 here into this index fund that gave you general exposure to the stock market, then your money would have grown from $10,000 all the way up to $33,000. And this is on the side without you doing any work. You just put your money in and then you go do something else. Now, I get it. Hindsight is 20/20. Of course, it's easy for me to look back and say, hey, you should have done this. But this is the reality of how investing works, okay? If you don't take risks, your money is not going to grow. Again, past performance does not indicate future performance, but let's just assume for a second that you can maintain that 13% return that we just saw in the previous example. But let's say that you don't have $10,000 to put into an investment. So instead of putting $10,000 cash into an investment, you do something a lot smaller. You do $250 a month. Now, whether the fund goes up or down, you're going to put $250 a month every single month into your fund, and you're going to do this no matter what, and you're going to do this for 10 years. So for the next 10 years, you're going to keep putting $250 a month into your investment, and over those 10 years, you will have put $30,000 into your investment. But assuming you get the same average return, your $30,000 will have grown to $63,000 on the side. But let's keep going. Let's say you do this for another 10 years. Now you will have put aside $60,000. So this is 10 years, another 10 years, over 20 years into your investment money. But because you're investing this money, you will have grown this money to over $270,000. You got more than $250,000 in your investment account because you're investing this money passively. Again, this is assuming you got a 13% return, but I got this number from the last 10 years of how the stock market has grown and how these index funds that match the general stock market have grown. I'm not saying this is what's guaranteed, but I'm showing you what's possible if you invest your money. And the great thing about this is this investment is passive. You're not trying to find the best stocks. You're not trying to research other companies. You're just putting your money into an investment that's investing in stocks for you. The reason so many people don't do this is because investing in passively managed index funds is not as cool and it's not as hot as trying to find the next Tesla or Amazon. The reality is building long-term sustainable wealth and growing it in the stock market is not easy. Yeah, it looks easy when you're in a bull market because everybody's making money. Then it's easy. You can just throw your money anywhere and you're going to make money. But when things go bad and times get rough, which will happen, you have to anticipate this. This is where you have to have a strategy, and if you are investing in index funds, it's all about just consistently investing every week or every month and letting your investments grow and compound over time. There are index funds for almost anything you can imagine. You have your general stock market funds like VOO, which I talked about. VOO was created by Vanguard, but you have other ones like SPY, which are not created by Vanguard. Both of them invest in the top 500 companies in the stock market. But you also have sector-specific funds, so these are a little bit more narrow. So these are things like tech funds and growth stock funds and real estate funds and dividend stock funds. Vanguard was the first company to really go out and create these type of index funds, but now lots of companies have them. Now I know this might be a little bit confusing, but finding an index fund is actually a lot easier than you might think. Let's say you want to invest in tech stocks, but you don't want to actually find the best tech company to invest in, so you want to go this fund route. So what you could do is you go to Google and you just search best tech index funds, and what's going to come up is you're going to see all these lists of tech ETFs. All an ETF means is it's a fund that you can buy through a stock brokerage digitally. Remember, back in the day, you couldn't always buy these funds digitally. You had to call up a broker and manually do it. So an ETF just means you can do it digitally. Two things that you want to make sure you pay attention to are what companies your fund invests in and what the fees are. Again, this is very easy to do. You just got to Google it. Going back to VOO, if you go to Google and you search VOO details, it's going to take you to the Vanguard website, and you can see the list of all the companies that VOO invests in and the different percentages that it invests in, and you can also see the fees, which is called the expense ratio. At the time we're recording this video, you'll see that the VOO expense ratio is 0.3%, which means for every $100 you invest into this fund, they're going to charge you 3 pennies as a fee for every $100 you invest. So this isn't a lot of money because they're using a computer to help manage your fund. They don't have this fancy guy, an expensive guy with a mustache who you have to pay a ton of money to invest your money and manage your money. The key here is having the right mindset, because you want to be investing for the long term, because this is a long-term wealth building play. We're going to jump back into the video in just a second, but before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who have been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, then Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well then you can stay. And if you decide to stay, it's not gonna cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you wanna try it out, I'll put the link to how you can learn more and join Market Insiders with a free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you wanna learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. I've been talking about a lot of things that are happening in the economy on our YouTube channel, from the oil crisis to mortgage rates to the credit system. Well, if you're a newer stock market investor, you're probably just trying to figure out how can you use all this information to make money in this crazy stock market. Well, you're in the right place, because because in this video, I'm going to be going over how you can invest your money smartly and how you can take a small stock market portfolio with as little as $100 and turn this portfolio into something worth $10,000 or $100,000. It's all the same strategy. All you got to do is just scale the numbers. Investing in stocks, especially if you're a newer investor, can be very overwhelming because you have a lot of moving pieces. I mean, you have companies and stocks, you have dividends, you have financial statements, you have stock charts. It can be a lot. And to top that off, you are competing against an expert on Wall Street making $1 million a year to devote themselves to the stock market and know everything about the stock market. So how in the world are you supposed to be able to compete with them? Well, it's actually easier than you might think. By the time we're done with this video, you are gonna know how you can beat the majority of investors, even if you have no idea on how to analyze a company or how to even buy and sell a stock. Most people think that stock market investing is about picking stocks. Like, how can you find the next Amazon before it becomes Amazon? That's one of the biggest lies out there, and it's one of the reasons why 90% of investors lose money in the market. There is a business for this on how to find the next big company, but there is a lot of time and energy and investment knowledge required to do this the right way. And unless you're planning on devoting a big chunk of your life to the stock market, this is not for you. If you get into this game, you're going to be spending a lot of money on how to find the next big stock pick. And the only person that's going to be getting rich on making these stock picks is the person selling these stock picks and not you. Look, stock picking is fun. And I think that can be a part of your portfolio because, you know, it keeps things interesting. But do you know when the majority of people buy a stock? It isn't when no one's heard of this random company that's innovating, that's about to break out. It's after this company has already seen a huge run and now is on the news because it is the next big thing. But if you're hearing it on the news, you already missed the rally. I'm gonna say this again. There is a way to find these companies and invest in these companies and make a lot of money doing that. But if your goal is not to spend a whole bunch of time trying to study the markets and become a professional stock market investor, then this is not for you. Stock picking takes a lot of time and you need to know how to filter out your emotion because emotion is one of the biggest killers on the stock market. But just because you shouldn't be picking stocks doesn't mean that you shouldn't be investing in the stock market. What you should be doing is investing in ETFs, exchange traded funds, that match your risk tolerance. You can think of an ETF kind of like a big group of stocks. Now, instead of you going out and just buying the McDonald's stock, you can buy a fund that is comprised of the McDonald's stock and the Disney stock and the Facebook stock and the Amazon stock. If you invest all of your money in the McDonald's stock and then people start going to McDonald's and they start eating fries and they find something really nasty in their fries. Ew, did you say they put guacamole in their fries? Wait, that's actually not a bad idea. Hypothetically speaking, if people found guacamole in their fries, then the McDonald's stock might go up because they're being innovative. But if people found something nasty like fingernails in their fries, then their stock might tank and so would your investment. That's a risk you probably don't want to take, especially as a smaller investor, because now all of your money is invested in one company and you can't control what they do. So if they screw up, then you screw up. If you're looking for a way to just invest your money and grow your money, then you want to make sure that your money is safe as possible with big upside. Typically, you want to be investing in something like 3 to 7 different ETFs to give you exposure to different markets. But if you're just starting with $100, then 1 or 2 ETFs is plenty. You can add more into your portfolio as your portfolio gets bigger. Remember what I said in the beginning of this video about understanding your risk tolerance? Well, this is where understanding your risk tolerance comes in handy. There are ETFs for almost anything, and the funds that you invest in are going to depend on how aggressive that you want to be with your money. If you're looking for that stable and steady growth, then you should be investing in funds that mimic the general stock market. VOO and SPY are the two most common names here because both of these funds will give you exposure to the top 500 companies in the stock market. So if the stock market goes up, so will your fund. If the stock market comes down, your fund goes down. Before I go any further, let me just remind you, I am not telling you what to invest in. I'm just giving you examples because investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you do your own due diligence and don't just blindly listen to a random guy on YouTube. Who you calling random, Jaspreet? If you want to be more aggressive with your money and like you want a piece of some of the hot tech stocks out there, then you can look into investing in a tech ETF like VGT and OGIG. You can invest in startups with growth stock ETFs. You can invest in healthcare with healthcare ETFs, and you can invest in foreign and developing countries with emerging market ETFs. Now, you don't have to try to differentiate and fight between companies. Like, you don't have to decide, should I invest in McDonald's or should I invest in Domino's? dominoes. Now you can get exposure to a whole industry by investing in an ETF. Finding ETFs is pretty straightforward. All you have to do is go to Google and then enter in what industry you want to look in and then add the word ETFs. So if you want to find bank stock ETFs, just go to Google and search bank stock ETFs and you will see what there are out there. Plus you'll be able to see which companies an ETF is invested in. That way you can see which companies you're getting exposure to by investing in a certain ETF. Generally speaking, your general stock market ETFs are going to come with less risk than your specific sector ETFs, like let's say the tech stock ETFs, because now you're getting exposure to more things. But this is where you need to know, okay, do I want more risk or do I want more stable growth? This is where you really need to understand your goals and make sure that your goals align with your risk tolerance. And I'm going to put some numbers on this in just a minute so you can see what it takes to grow a $100 portfolio to a $10,000 portfolio or bigger. But before I get into that, I want to show you how you can actually invest in these ETFs. If you want to invest in stocks, you have to use a stock brokerage, and you want to make sure that your stock brokerage isn't charging you excessive fees or commissions, because you want to make sure that you're using your money to invest instead of using your money to make your broker richer. All right, now we got the basics down. You know how to invest, you know about your risk tolerance, and you know how to find an ETF. Now, how do you turn a $100 portfolio into $10,000? Well, it's all math. The historical average stock market return is 10% a year. Now, that doesn't mean that the stock market's gonna go up by 10% every single year. That means something like, okay, one year the stock market might go up by 30%, and the next year it might go down by 5%, and on and on and on. But over the long run, the stock market has gone up by around 10% a year. At the same time, the majority of stock market investors lose their money even though the stock market goes up over the long run because they don't have the right education. Or maybe because they were trying to trade hot stocks, trying to get rich quick. Or maybe because they were trying to trade on emotion, or maybe it's a factor of all of these. But you have the right education now, so let's start with the most conservative approach. Let's say you only have $100 to invest today, and then every month you add in another $100 into your portfolio, so that's $1,200 a year that you can invest. And you just take this money and you are putting it into a general stock market ETF like VOO or SPY, and now you're just trying to match the stock market. If you do this every month, you just throw $100 into your investment portfolio and you just put it in this one general stock market ETF and you're just trying to match the market. You're getting a 10% return a year. Now, you will have a $10,000 portfolio in just 6 years. Now, you're not trying to pick the perfect stock or trying to find the next hot stock. You are just trying to match the market. The three factors that will determine how much money or wealth you make in the stock market are how much money you invest, how long you invest for, and what returns you get. The longer you invest for and the more money you invest and the better returns that you get on your investments, the more money you'll make. But what you might find interesting is that your returns don't grow in a linear line. They actually grow on a curve like this because the more money you put in and the longer you put your money in for and the longer and better your interest rates are, then the better your returns will get. And now you're not just growing your money, you're compounding your money, which means now your money is making you money and the money your money made is making you money. So you're adding speed on your side, which means the longer you do this, the faster your money will be making you money. Now, I get it. Investing your money can be scary, especially when we're in a recession like we are in right now, because you could invest your money and then see your stock market portfolio go down and nobody wants to open up their portfolio and see red. But what you have to remember is the real money isn't made over 2 months. The real money is made over the long term, and that's what you're going to be doing here. If anything, when prices crash, you should be buying even more aggressively because that means it's an opportunity for you to buy great investments at a discounted price. But now let's say you want to be a little bit more aggressive with your money and you want to be involved in the tech space because you really like tech and you think that's the future. Well, then you can invest your money into something like VGT, like I talked about earlier. And over the last 10 years, VGT has gone up by about 18.5% a year. And over the last 5 years, it's gone up by around 20% a year. Now, again, past performance doesn't predict future performance, and investing in one specific sector comes with more risk, but also the more potential to make more money. Now, if you do the same thing and you get the average 18.5% return a year, which isn't guaranteed, but if you do, then you will have a $10,000 portfolio in just 5 years. And that's just $100 a month. Imagine if you invested $200 a month, or $2,000 a month, or $5,000 a month. The key here is consistency. And picking stocks is fun, but it's not profitable for the majority of people. I mean, are you in this game to do what's fun or to make money? Like, if you want to pick stocks, that's fine, but then you need to actually put in the work and devote your time, effort, and resources to learn how to do it the right way. But this is where financial education is so important, because it allows you to compete with the big time investors on Wall Street without having millions and millions of dollars to invest, because you can just put your money into the right funds and let the funds do the work for you. The most difficult thing about investing your money right now is just trying to figure out what to do. Like, should you cash out of your 401k and buy this picture of an ape, an NFT with lasers shooting out of his eyes? That's exactly what a photographer did, and it net him $1.4 million. This is one of the reasons why people are so confused about how to invest their money right now, because you see some people making a killing buying things like pictures of apes, and then you see other people that are losing money while investing their money into solid companies. And then you have these millionaire millennials that are saying that they are getting ready to sell their stocks this year, but JP Morgan Chase Bank says, hold on, don't sell your stocks. People are way too bearish about the market in 2022. Then exactly 1 month later, JP Morgan came out again and said something a little bit different. JP Morgan said, JK, we're just kidding because we are in a bear market, but you should buy the dip. This is why so many investors are confused, because if you save your money, it's getting eaten away by inflation, but if you invest your money, you might see it get cut in half. It feels like every time the Federal Reserve Bank comes out and says that inflation is not a big deal, you don't need to worry about it, inflation ends up becoming an even bigger deal, which is why Ray Dalio keeps saying that cash is trash and why you need to be investing your money. So what I want to do today is talk about what I'm doing with my money, because I'm going to buy a very expensive picture of an ape. Just kidding. Or am I? When I invest my money, I follow two general kind of high-level strategies. I have a passive strategy, which I'll talk about first, and then I have an active strategy. A passive strategy is exactly what the name says it is. This is completely passive. This is money that's automatically invested that I just set and I don't touch. My active strategy is a little bit different. In my active strategy, these are investments that I'm actively looking for, that when I find a good deal, that's what I'm going to go out and buy. So let's start by talking about my passive strategy. There are three places where I am passively investing my money. I'm passively investing my money in stocks, I'm passively investing my money in crypto, and I'm passively investing my money in physical commodities like physical gold. The nice thing about a passive strategy is you don't need any sort of dollar amount to start investing your money. Like, you can start passively investing your money with as little as $100. You just need to figure out what it is that you want to invest in and at what cadence. In the stock market, I'm investing weekly, every single Wednesday. In the crypto market, I'm investing every single day. And in the gold market, I'm investing once a month. I don't have any of the traditional retirement accounts. I don't have a 401k. I don't have an IRA. I'm not a big fan of those. I mean, they're great places for you to start. They're great for the average investor, but once you learn about how to invest your money, you're going to see that there are other ways that you can get the tax breaks, where you can get better returns, where you can have better control over your money. So I like to invest my money myself. When I passively invest my money in the stock market, I'm not passively investing into individual companies. I'm looking for ETFs. I'm looking for funds that gives me exposure to the general market or indexes that I want exposure to. Right now, this might change in the future, but right now I'm investing my money into three different categories of ETFs in the stock market. The first category is ETFs that give me exposure to the S&P 500. The second category are ETFs that give me exposure to innovation, and the third category are ETFs that give me exposure to emerging markets. The reason why I picked these three different things is because now I'm creating a portfolio that benefits me regardless of what type of economic environment that we're in. Does this mean that my portfolio is going to be up every single month? No. I mean, investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly listen to a random guy on YouTube. But the reason why I like these three different funds is because my S&P 500 ETFs give me exposure to the biggest 500 companies in the stock market. So those ETFs are giving me exposure to the general stock market and the general American economy. If our economy is growing, these ETFs will grow. If the economy is not growing, then these ETFs are not going to grow. Then in the second category of ETFs, I'm investing in innovation. Innovation are companies that are investing in new type of technologies, new things that might be used in the future. This is a higher risk because there's a chance that some of these companies will fail, but I'm a big believer in things like fintech, the financial technology space, because, well, I love finance and I understand the space and I work in finance, so I like investing in that space. And I also like things like genome technology, the future of healthcare. And then I also have ETFs that give me exposure to general innovation and general growth that was not just one particular sector. I'm not going to go over each individual ETF and how to analyze them in this video because I've already gone over that on our channel. So if you want to watch that that video. I'll link it for you in the description below. And then I have the third category of ETFs, which give me exposure to emerging markets, which means that these ETFs are investing in companies outside of the United States. Each of these three categories thrive in a different point in our economic cycle, which is why I like to invest in all three of them. Like in the emerging markets, when we have a lot of high inflation in the United States, people are worried about the dollar, people are worried about the American economy. Well, that's when you can see more growth in the emerging markets. And if you start to see more companies outside of the United States and more countries outside of the United States grow, well, that's good for that category. When you're in a period of low interest rates and high growth, that's when the innovation companies can see a lot of upside. And then I have my safer S&P 500 ETFs, which is more protectionary, where if the economy grows, you'll see this ETF grow over time. There's three keys that I follow that really anybody needs to follow if you want to make any sort of passive investing strategy profitable. The first thing is this has to be automatic. That means now you're going to have money automatically deposited, whether it's once a week or every 2 weeks or every month. It's going to be automatically pulled out of your checking account and it's going to go into your investment portfolio. The second thing is it needs to be consistent. That means it has to happen every week or every 2 weeks or every month. You got to be consistent whether the market is up or down. You're not trying to time the market anymore. You're going to let the market do its thing and you're going to automatically consistently invest your money, and then you have to give it time. Time means this is not something you're going to do for 6 months or a year. You're going to do this for years and you're going to let this build, compound, and grow. This is how you build a profitable passive portfolio over time that can grow, compound, and build you serious wealth without you having to do anything. Like if over the last 40 years you invested just $500 a month into the stock market and you were able to get an average 10% return, that doesn't mean you're getting a 10% return every single year. That means the average is 10% a year, which is the historical stock market average. That $500 monthly investment would have grown to almost $3 million with you doing nothing else except you just passively investing your money. I use M1 Finance to passively invest my money in stocks. They are a sponsor of Minority Mindset, but I like them because they're super easy to use, it's pretty simple, and it's free if you're just investing your money. So if you want to learn more about M1 Finance, I'll put our link to how you can do that in the description. My passive strategy for crypto is very different than stocks. Now, the first thing you got to understand is crypto is speculative. It's risky, it's very volatile, so you first have to believe and understand the value of crypto before you start investing your money in crypto. Now, I believe in crypto, I like the future of crypto, which is why I invest in it, but you first have to start there. Do you believe in crypto or not? If not, then this doesn't matter. The thing that's the same between passively investing my money in crypto and passively investing my money in stocks is you need the same three keys. It has to be completely automatic, it has to be consistent, and I have to give my investments time. If you want to invest your money in crypto, you have to understand that this is not trading. When I invest my money, this is something that I want to own for years, where my portfolio is going to have time to build and compound. I have two different goals when I'm passively investing my money in crypto. One is generating interest, and the second is acquiring more cryptocurrency. There are certain cryptocurrencies that I can buy which will pay me for interest if I put them into a certain account, because this account is going to work almost like a bank. It's not a bank, but it's similar to a bank, where they're going to work to lend out the cryptocurrency and I get paid interest for keeping my cryptocurrency in this account. It's not tied up like a CD. I can pull my cryptocurrency out anytime that I want, but I'm getting interest for keeping my cryptocurrency in this account. So what I do is every month I buy a few stable coins. A stable coin is a cryptocurrency which is stable. That's why it's called a stable coin, where one stable coin is equal to the value of $1. So one stable coin, $1. If I buy 100 stable coins, it's going to cost me $100. And so I buy stable coins every month, and then I put these stable coins into an interest-bearing account. This is where I moved a big chunk of my savings and where I have cash that's waiting to be invested in an active investment. I'll get there in just a second, but this is where I'm keeping a big chunk of cash because it's earning me much better interest than I would have gotten if I just left this money in the bank. Like right now, at the time of me recording this video, I'm earning more than 8% a year in interest on my stable coins. And again, I can pull these stable coins out at any time, and you don't see the same fluctuations and volatility with stable coins that you see with cryptocurrencies because again, they're stable. If I buy $1,000 worth of stable coins, I can sell the 1,000 stable coins and get $1,000 back. That doesn't mean that it's risk-free. I mean, something could happen to my stable coins or something could happen to the interest-bearing account, but this is where I keep a big chunk of savings because I am earning a much higher interest rate here than I would have gotten than if I kept my cash in the bank. I use a platform called BlockFi to do this. They're also a sponsor for Minority Mindset. It's gonna seem like this video is just one big pitch video, but that's not what I wanted it to be. I just want you to know which platforms that I use, but I use BlockFi. I like them because they're easy to use. use. They don't charge you anything. They pay you good interest rates, and they take better care of your money than some of the other accounts that pay you much higher interest rates. So if you want to learn more about BlockFi and try them out, I'll put the link to how you can do that in the description. The second thing that I do with cryptocurrency is I acquire more cryptocurrency every single day. So I have a dollar cost average system set up where every single day I'm buying a little bit more of Bitcoin and a little bit more of Ethereum and a couple other of the smaller coins, but most of my money is going to Bitcoin and Ethereum. That's why I don't care if Bitcoin is crashing or booming, because my strategy says that every day I'm just going to be buying a little bit more. My goal here is just to acquire a bigger portfolio of the cryptocurrencies that I believe in and let this portfolio build and grow over time. And then I have a passive strategy for how I invest in physical gold. Gold is a hedge against inflation. That's why I invest in gold, because it's kind of like financial insurance. When you own physical gold, you own real money. Gold doesn't work like stocks, because when I invest in a company or when I invest in these ETFs, these companies are working hard every single day to increase the amount of value that they put out. So if I invest in the Amazon company, Amazon is working hard every single day to produce new products, to generate more revenue and to make bigger profits, to help drive the value of Amazon up. In gold's case, it doesn't work like that. When you buy some gold, you put it in a drawer and it just sits back and looks at you. It doesn't do anything. Now, while my physical gold isn't working to produce more value, what it does do is it gives me financial insurance, because as the value of the dollar goes down because of inflation, and we all know that inflation is not slowing down. We saw 7% inflation in 2021. Who knows how much inflation we're going to see in 2022 and 2023, but as inflation stays high, that also means that the price of gold will probably go up too. The reason why the price of gold goes up is not just because gold starts producing more value, it's because the value of the dollar is going down. Between 1913 and now, the United States dollar has lost something around 96% of its buying power, because the Fed keeps printing more and more money, which devalues the value of the dollar, while at the same time, over the last couple of decades, we've seen the price of gold shoot up because the value of the dollar has gone down. So I don't look at my gold as an investment. I look at it as savings, because now I'm saving real money. It's tangible, it's physical, it's something that I can see, feel, and touch. Because if I wanted to save $10,000, I ask myself, would I rather take $10,000 worth of cash and bury that in my backyard? Or would I rather take $10,000 worth of physical gold today and bury that in my backyard? I think that in 10 years, that $10,000 worth of physical gold today will have more value than the $10,000 worth of cash that I buried, which is why I like to have this gold as real money. I use a platform called Vaulted to buy physical gold passively. Again, they are a sponsor of Minority Mindset. You don't have to use any of our sponsors. Please do your own research, but I like Vaulted because it is completely passive. You can do it automatically, and you can let this happen on its own. So you can buy any amount of gold that you want, and then the money will sit there. It will buy physical gold. So as you invest more money in your account, it will show you how much physical gold that you own. And once you own enough gold to buy a whole gold bar, you can have this gold bar stored in a vault, or you can have it shipped out to you. If you want to learn more about Vaulted, you know where to find them. I'll put their link down below in the description. And this brings me to my second strategy, which is my active investment strategy. While my passive investment strategy happens automatically and it happens consistently, I'm investing in the stock market every single week. I'm investing into cryptocurrencies every single day. I'm investing into physical gold every single month. My active strategy doesn't work like that. There are 5 different places where I actively invest my money. I invest my money into my business, into real estate, into startups, into stocks, and into cryptocurrency. And my goal here is to look for the best opportunity. This isn't something that's just going to happen automatically. This is where I'm actively working to find deals. I'm actively looking for a good opportunity where I can put my money and maybe my time too. And now I am working to find the best possible deals. Let me start here on the business side of things, because I did a lot of soul searching in the end of 2021 and the early part of 2022, trying to figure out exactly what it is that I want to do. Minority Mindset started off as a business. We had a whole bunch of things going on. We had some classes, we had an app, we had a blog, we had a financial newsletter, we had an education newsletter, and I started to ask myself, what is Minority Mindset? How is that separate from Jaspreet Singh, and how is it separate from the business? Because anytime you'd ask somebody about Minority Mindset, they would assume that that's just Jaspreet Singh. And so we made the decision in the early part of 2022 that Minority Mindset is now going to become just my personal brand. It's going to become an extension of me. So Minority Mindset will be Jaspreet Singh. And so the minorityMindset.com will just be my blog, and all of our other products and other companies are going to be separate. One of our products, which is now split off into its own company, is Market Briefs. If you've been subscribed to our financial newsletter, you already know what Market Briefs is. Market Briefs is our daily financial newsletter. Every day, my Market Briefs team is sourcing the finance and business news to see what's happening, to see what's important, and then they break this down into a fun, entertaining, and witty newsletter that you can read in less than 5 minutes, and they send it out to you every morning, Monday through Friday and Sunday at 7:30 a.m. Eastern Standard Time. So this is one company which is spin off into its own brand, Market Briefs. You can see it at marketbriefs.com. And then we also have Market Insiders, which is our financial education app. We'll be launching this app in the App Store by the second quarter of 2022, but essentially in this app you get on-demand video lessons from stock market, real estate, and cryptocurrency coaches, and this is live and you get to watch these every single week. So every week you're going to get access to a stock, real estate, and cryptocurrency coach. Every week they're going to be giving you live lessons, and you can watch these on your app, on your computer, on your desktop whenever you want. Again, if you want to learn more about that, you can go to marketinsiders.com and try it out for free with a free trial. So I've separated these two companies into separate entities, and now I am working to grow these two separate entities. And this is where I had to ask a question to myself. What do I want to do with my excess money? Do I want to take this cash and go out and buy some real estate or some stocks where I could get a decent return, maybe 7% a year? Or do I want to take this cash and help grow these companies? Every entrepreneur, every business owner goes through this question. What do you do with excess money? Do you reinvest it back into yourself, or do you take this cash and then put it into a passive investment? These passive investments have the goal of giving you a passive return, hopefully somewhere between 7 to 10% a year. That is the goal that you're looking for with most passive investments, with stocks and real estate especially. And so now I'm trying to ask myself, what do I really want to do? Do I want to help build these businesses, or do I want to just go out and buy some more real estate? And I see a lot of value with the businesses that we have, and I'd like to start growing these some more. So what I'm going to be doing a lot in 2022 is just investing this money back into me, back into my businesses, whether it's through marketing, whether it's through hiring more team members, whether it's through investing in my own education or consulting. I'm going to be investing this money back into my business. This will be my biggest investment in 2022, hands down. I mean, they always say that the best investment that you can make is yourself, and I do already have some investments here. And I think it's time for me to make a little bit more risky investments. And in this case, that is going to be my businesses, but I can mitigate some of that risk because I know the person that's running these companies. It's me. So I believe in myself, I believe in our products, which is why I'm going to be investing very heavily into these businesses. Again, if you want to check out the businesses and help support, you can go to marketbrief.com to check out our free financial newsletter, or you can check out marketinsiders.com to check out our financial education app. This brings me to number 2, which is real estate. I've been investing in real estate for just over a decade now. And if I look at my passive investments, real estate, stocks, cryptocurrencies, startups, and physical commodities like gold, real estate is definitely the biggest chunk of my portfolio. I like real estate because when I invest in real estate, I'm looking for one thing: cash flow. I don't care about appreciation. I don't care about home values. The thing that I'm looking at is how much money do I have to invest today, and how much money am I going to get paid in passive cash flow every single month after that. When I invest in real estate, I'm looking for growing areas and I'm looking for good deals. So I'm looking for a property that's beat up where I can find a good opportunity. I'll buy this property, renovate it, and then rent it out, and then I will use this property to pay me with passive cash flow. I don't want to go over the ins and outs of real estate investing in this video. I've made other videos where I talk about that, but the thing that you have to understand about real estate is, in the beginning, it is anything but passive. It is a ton of work. You have to go through the learning hurdle. You have to go and meet other team members. You have to find the right people. You have to learn how to deal with tenants. You have to learn how to deal with property managers. You have a big learning hurdle that you have to be able to get over. But once you do that and you have the right team, investing in real estate can be very passive after you buy a property. I'm still involved when I buy a property in the renovation side, but after a property is renovated, I will give the keys over to my property management company and I'll let them do everything after that. I'm always looking for real estate deals. I have real estate agents that I'm working with. I am a real estate salesperson myself, so I have access to the MLS, which is the real estate database. So I'm always looking for real estate deals, but one of the things that I decided in the later part of 2021 is that I am going to not buy as much real estate this year because I want to invest more heavily here. Now, if I do see a great real estate deal and I have some extra cash that's not being invested here, sure, I will go out and buy that real estate, but I know that I'm not going to be buying as much real estate because I have more cash going right here. This kind of works out in my favor because we have so much craziness happening in the housing market right now, but that also does not mean that I will not be buying any real estate. I am planning on buying some real estate in 2022 as an investment, just not as much as I would have if I wasn't investing so aggressively here. The third way that I'll be actively investing my money in 2022 is into startups. Now, back in the day, this used to be very hard to do. If you wanted to go out and invest your money into a startup company, it was going to be very expensive, very hard, and they wouldn't even care if you were offering them money unless you had a decent chunk of change. But nowadays, thanks to something called Reg CF, which stands for regulation crowdfunding, which means you can now invest into startups even if you are not an accredited investor. So now anybody can go out and invest into these type of startups, and you have platforms like WeFunder and Republic and Start Engine, which make it super easy, where now you can take as little as $100 and go out and invest into any one of these startups, and now you get a piece of the upside, because now you can invest into a company that you believe in an early stage, and if this company gets acquired or if this company goes public, chances are you are going to get a big payday. But the risk here is there's also a big chance that this company is going to go bust. When I invest in startups, I know that there's a high probability that this company is going to go nowhere. So it's much riskier because you're investing in an early stage company. You're investing in a company that's trying to grow, that's trying to become profitable, that's trying to maybe get acquired, maybe go public. And so you only get paid here with these startups if this company goes public or if it gets bought out by another company. If it never gets bought out, if it never goes public, well, you might never see a return on your money. That's why startup investing is much riskier, but you also have a whole lot more upside. I have a little bit of an advantage here because I'm an entrepreneur myself, so I know what to look for. Plus, I have a platform where a lot of startups are looking for this type of exposure. So one thing that I can do is if I find a company that I believe in, I can work with them where they will give me a piece of the company, some equity, in exchange for exposure on my brand. So I know I'm really lucky where I have a lot of leverage with these startups, but I like investing in startups because it's fun for me. I am an entrepreneur. I love entrepreneurship. I love promoting entrepreneurship because growing up, I was never told that entrepreneurship is okay. It was very much discouraged in my household. I grew up in a traditional Indian house. I was supposed to be a doctor. Anything that's not a doctor is a failure. So I had to go through a lot of hurdles trying to start my own company, trying to do all this myself. But now, because of that, I love entrepreneurship and I try to support entrepreneurs any way that I can. So one of the ways that I do that is by actually investing into these companies. Now again, I won't be investing in as many companies as I would have if I wasn't investing so heavily in my business, but I'm still always looking for deals in the startup space. And then we have stocks and crypto. Now this falls more on the traditional investing side, where here I'm just looking for opportunities, okay? If the stock market crashes, if the cryptocurrency market crashes, I'm going to be coming in and buying. I know which companies I like. I know which companies I believe in. I'm researching these companies. These are things that I do in my free time. I like studying the markets. I'm a money nerd. I know. I enjoy doing this. I like listening to the earnings calls. So I know which individual companies that I want to own. And if these companies crash, well, that's an opportunity for me to come in and buy. I talk about this all the time on our channel, but most people are scared of market crashes. Most people are scared of recessions. But the thing that you have to understand is that market crashes and recessions make more millionaires than any other time, because it's like Black Friday for investors. It's a time for you to go out and invest aggressively because you can buy assets for pennies on the dollar. Imagine if you would have bought stocks in the 2020 stock market crash. Imagine if you would have bought real estate after the 2008 crash. Imagine if you would have invested into the stock market after the 2000 dot-com bubble. So there's always opportunities. You just need to know where to look. I don't like chasing stocks. I don't like chasing cryptocurrencies. I have a passive strategy. My passive strategy gives me exposure to the stock market. It gives me exposure to the cryptocurrency market. It happens every week. It happens every day, whether the market is up or down. I let that happen no matter what. But when I'm investing in individual stocks, not an ETF, but individual stocks, I'm looking for deals. So I'm waiting to see the price of the stock come down to where it's a good price where I will come in and buy. And if I see a market crash, you bet I'm going to be coming in and buy. When the cryptocurrency market crashes, you bet I come in and buy. But I want to buy something that I like the price of, where I think it's a good deal, because I don't want to be the person that's chasing the assets. The last thing that I want to mention is this. You don't need a ton of money to start investing. This might seem overwhelming where, oh no, I don't have hundreds of thousands or millions of dollars to invest like this. You don't need that. Start with $100. If you have $100, just start passively investing your money. If you have $1,000, maybe you can start actively investing your money. You have to just get started. It does not matter how much money you have. You don't have to invest your money into 10 different things at once. When I first started investing, I first just started buying real estate. Then I started investing in stocks. Then I started adding in more things and more things and more things. But first, you have to start with one. You start with one, then you can grow into the second. Then you can learn about that. Then you can go to the third. You can't try to do everything at once, but you have to get started. It doesn't matter if you have $100, $1,000, $10,000. Start with whatever you have. Start investing and be willing to learn and be willing to lose. Because one of the biggest things that holds people back from investing their money is the worry that they're going to lose money. Well, if you understand that, yes, I will lose money, then you're going to be much more likely to invest, and you're going to be much more likely to learn, because when you have skin in the game, that's when you are going to learn the most. So you have to just get started, be willing to learn, be willing to lose, and be willing to try things, and then you're going to see what you like, you're going to see what you don't like, and that's when you're going to learn how to be the best investor possible.
My friend Dave Ramsey says, live debt free. I'm going, well, you're an idiot. I mean, he's my friend, but I say, Dave, I like debt. He says, I know, but most people can't handle debt. I said, I agree. But that's why there's no financial education in schools, because if you knew how to handle debt, you wouldn't save that crappy dollar you have in your hand.